How do you get steady, consistent income every month without worrying about the stock market? Now, this is one of the questions I get every time I sit down with somebody. And it's a great question because once that paycheck stops, your bills don't. So today, I'm going to walk you through different ways you can create consistent monthly income in retirement from simple to sophisticated. And at the very end, I'm going to share a unique income strategy that most retirees have never even heard of, but it can provide both protection and growth potential at the same time. And it's not an annuity. So stick around because this might change the way you think about retirement income entirely. Now, quick favor before we dive in, if you find videos like this helpful, please tap the like, subscribe, and hit the bell so you don't miss new strategies. So let's jump in. All right, if you don't know who I am, I'm Vince Oldre. I'm a certified financial planner, president of CFG Retirement, and we help people enter near retirement turn their life savings into reliable, tax-efficient income. And in this video, I'm breaking down the top monthly fixed income ideas so you can enjoy retirement without stressing about market swings. Now, I'm not all about fixed income ideas or fixed income vehicles. This is just one segment of all the videos I've created to help you find other vehicles that are more geared towards fixed income. There are, of course, other strategies you can use that would have more growth and still give you income, but we're going to focus just on some fixed income ideas for today. Now, these strategies we use with our clients every day. So when you retire, one thing you got to keep in mind is that you shift from the accumulation to distribution. Now, I write this in my book called Retirement Unlocked, and it's a big proponent of retirement. It's no longer how big is my portfolio, it becomes how much income can my portfolio safely produce each month? Because retirement isn't about a number, it's about cash flow. Social Security helps, maybe you even have a pension, but most people still need another $3,000 to $6,000 a month from their savings. That's where fixed income vehicles can come in. Tools that pay steady, predictable income so you're not forced to sell shares in a down market just to pay the bills. So let's dive in. Now, one vehicle that's commonly used and commonly talked about, maybe not everyone's favorite, is annuity. Now, an annuity you can think of as like your own pension. You give an insurance company a lump sum of money, they give you a guaranteed income, often every month, for life. Now, there are two main types of annuities. One is an immediate annuity, which the income starts almost right away. And then there's deferred income annuities where income will start later. And usually, deferred income annuities pay more because you waited. The pros are there's guaranteed lifetime income, predictable and simple, and you can even add in some optional inflation protection. Now, the downfalls is that there's limited access to your money. So once you do it, it's pretty much permanent. Now, payments depend on the insurance company, and they're not really designed for big growth. So they're great for people who want a steady paycheck for life. Another fixed income vehicle you can use are bonds and municipal bonds. Bonds are the foundation of fixed income. You lend to a company or a government, they pay you interest, often monthly through funds or exchange traded funds. Now, corporate bonds tend to pay you a bit more. Municipal bonds can be tax-free, so they tend to pay a little bit less. So that's where you have to come up with a calculation as far as what's your taxable amount when you're looking at the corporate bond. Are they better than the municipal bonds after taxes? So that's a big benefit for high-income retirees when it comes to municipal bonds. Now, the pros here is the reliability, especially if you're looking at investment-grade bonds, return of principal at maturity, and tax benefits with muni bonds. Now, there are some downfalls. When interest rates rise, the existing bond value or bond prices fall, so you could lose money in a bond fund or a bond in general. And inflation can erode the spending power because you have that fixed payment. One way to reduce some of that rate risk is something called a bond ladder. We often build a bond ladder and look at more individual bonds rather than the mutual funds, so that way we can have a little bit more control and you have more control and not have the interest rate risk that these mutual funds would have. Instead of a long-term bond, what we would do is we would buy a mix that matures at different years. As each one matures, you reinvest, possibly at higher rates. Now, part of the downfall is it could be a lower rate. Now, this keeps income steady and adds flexibility. Another thing you can look at is dividend paying stocks. Now, these are going to be a little bit higher in the risk scale. Dividend paying stocks, they give you the nice dividend and it will pay out quarterly if you're looking at individual stocks, maybe annually. And then you can look at some dividend ETFs where they would usually pay out monthly dividends. These can provide income and potential growth, but you have to keep in mind there is still some risk here. And because dividends can increase over time, it does help with inflation, but we also have to think about that the stocks have price fluctuation and the dividends aren't guaranteed. But still, it's a great option for those who want income and the chance to grow that income. One other thing you could look at is real estate investment trusts or REITs. Typically, I would not recommend a private real estate investment trust because I don't want you to lock up your money and it's really hard to unwind. But if you're looking at publicly traded real estate investment trusts, that's a different story. So think about you get to collect rent checks every month without owning a single property. REITs own apartments, office buildings, warehouse, retail buildings. They're required to pay out most of their income, and it often comes out monthly. The benefit here is you get higher yields, you have some diversification in a different sector, and then you have an inflation hedge. The downfall is there can be some volatility with them depending on what's going on in the market. Their taxes are in your income, and there's less liquidity, especially if you're in the private REITs. But if you want real estate income without the landlord headaches, real estate investment trusts can be very, very powerful. One other thing you can look at is preferred stocks. These are a hybrid type of investment, part stock, part bond. They pay fixed dividends higher than regular stocks. They're typically more stable than common stock, but still can fluctuate with the rates. Nice option for moderate risk tolerant retirees seeking a little bit higher yields. Then we have CDs or certificate of deposits and MYGAs or multi-year guaranteed annuities. For simplicity and safety, CDs are bank products. They're FDIC insured, very low risk. MYGAs are multi-year guaranteed annuities. They have a similar structure, but they're typically a little bit longer, 3, 5, maybe 7 years, where it's a fixed return, typically a little bit higher. Both give fixed returns. There's no market risk. Now, the downside is that with the annuity, you are tying it up longer, so there's a little bit less liquidity versus the CD. There is potential for inflation that would outpace them. You have to be careful there because every product is a little bit different. However, they are a great short to medium term safety type vehicle. We really don't have to worry about these vehicles defaulting or anything like that on a typical basis. Now, another thing you can look at is call ETFs. Now, this is getting a little bit more unique. There's a little bit different strategy here. So if you want higher income, these funds can deliver 7 to 12% yields. Covered call ETFs collect option premiums and pass that income to you, the investor. But there's a trade-off. There's lower upside in strong markets, a lot of complexity here, and potential long-term erosion if not chosen carefully. Some of these have really high fees, so you have to be careful here and look at the right ones. Now, these should be a slice, not the whole core of your portfolio, because they do have a little bit more volatility. One other thing you can look at is private credit and lending funds. This space has exploded recently. Funds lend to businesses or real estate developers. Investors share in the interest. There's really high income potential. But the downfall here is that there's a lot of credit risk. So typically we don't use these vehicles for our own clients. And the quality of the manager of these types of investments really matter. These are typically better for investors that are comfortable with longer lockups and willing to take a little bit more risk. All right, everything we just covered, they can all play an important role. But here's the problem. Each one solves part of the puzzle, but not the whole thing. Bonds and CDs protect you, but often don't beat inflation. Dividend stocks give growth, but they're not always the safest, or maybe you can't stomach the volatility. Annuities offer guarantees, but are very limited to liquidity. Then you have high yield alternatives that look really attractive, but they carry a lot of risk. And retirement today is harder than ever. People are living longer, inflation keeps rising, markets are unpredictable. So how do you design income that gives you growth, protection, and consistency all at once? Let's talk about a unique approach, one most retirees haven't heard about. Now, this type of vehicle, it's called an income structured banknotes. they're not necessarily new and they're not experimental. These have been used by institutions for years, issued by major banks like JP Morgan, Citibank, Bank of America, and so on. The benefit here is they can offer monthly or quarterly income with built-in protection against downturns. Here's how they work. You lend the money to a major bank for a set period, usually 1, 2, 3, or 5 years. Then in return, they give you a defined income stream linked to an index, often the S&P, the NASDAQ, Russell, or it could be some other index or actual stock or fund that's publicly traded. Now, as long as that index doesn't fall too far below a preset protection level, which could be all the way from 10, 15, 20, 25, 30, or even beyond 50%. Now, as long as it doesn't go below that protection level, you keep earning that income. And often we can see income in the range of 7 to 10% a year that's paid out monthly. And if the index finishes above that protection barrier at maturity, you just get your full principal back. Let me give you an example. You invest $100,000 in a 3-year income note. It's going to pay you 10% a year. That's over $800 a month. As long as the market doesn't drop more than 25% by the end of the term, at the end of the 3 years, you get all your principal back. If it drops more than that, your loss matches the amount below the barrier. So if the market went down 15%, you would get your full principal back. If the market went down 20, you get your full principal back. If the market was down, let's say 30%, then you would then lose 30%. So it's a bit of a cliff, so your loss matches that amount below the barrier. But meanwhile, you receive that income every month, and that's pretty powerful. So what we typically do here is we would ladder the notes out. That way we can mitigate that risk. You don't put it all into one and hope we didn't time the market wrong here. We want to make sure that we spread that risk out. So this is just, again, one idea that you can use that's a little bit more unique. Maybe a lot of people haven't heard of them. And part of the reason why is because they do require a lot of money to be invested in them. But if you use different strategies where you can use some advisors or institutions that help you get into these by pooling together, and it's still a publicly traded asset, it's a lot better for you. Why do retirees appreciate these? You get the consistent income, you have the defined downside protection, so you know what the rules are, right? It's a structure. You have better yields than most bonds. They're customizable to your needs. This helps you fill the gaps between safe but low yield products and higher yield but riskier ones. It's basically a bridge income tool, sitting between guaranteed income and your growth portfolio, helping support monthly cash flow, principal preservation, inflation defense, all in one design. Now, there are some risks you should know. There's issuer risk. So if a bank fails, that matters. Market risk, if the index falls too far, your principal can be reduced. And there is a bit of a liquidity risk because usually you hold to maturity. It's kind of like a bond. This is why these should be part of a diversified plan, not the entire plan. So the big picture here is most retirees want reliable monthly income. They want protection from big losses, and they want some growth to fight inflation. Income structured bank notes can help combine those priorities into a single solution. That's why they're becoming one of the more interesting retirement income tools today. So we covered a lot, from traditional income sources to more advanced options. Here's the main takeaway. There is no single best investment. The right mix depends on you, your goals, your timeline, your comfort with risk. But you can design income that lasts as long as you do and gives you confidence every single month. If you found this helpful, please tap like, subscribe, and hit the bell so you never miss new retirement income strategies. And if you'd like your own custom retirement income plan, or you want to see what other income structure bank notes make sense for your particular situation, book some time with me by clicking the link below in the description. Pick a time that works and we'll talk through your goals and the best mix of income tools for you. I'm Oldre. Here's to your confident, stress-free retirement, and I'll see you next time.